Good afternoon, everyone. I'm Matt Dimitroshin. I'm the Director of Investments at Telemus Capital. Thank you all for taking time out of your day and your afternoons to join us today. I'm privileged to have Ed Kerschner with us today and for an economic and market update with Ed. Ed is the Portfolio Strategist with Columbia Threadneedle. I'm particularly excited and feel fortunate to have Ed with us. Ed's a Wall Street veteran, has been in the industry since 1974, and across his career has had a number of different chief titles. In addition to being the chief portfolio strategist at Columbia Threadneedle, he was the chief investment strategist at Payne Weber, chief global strategist at UBS, and chief investment strategist at Citi Research. Held a number of different titles and seen a lot of different market environments. As a BA and MBA from New York University, and is a fellow CFA charter holder. So Ed, thank you very much for taking time to join us today.
Thanks, Matt. Good afternoon, everybody.
What I kind of wanted to do today was just to kind of get Ed's perspective on kind of what's going on in the economy and in the market. I have a number of questions I've been dying to ask Ed. So after that, I may ask those questions of Ed. And after that, we'll have some Q&A. So anybody that's participating today that has a question, please go to the Q&A box at the bottom of your Zoom screen and enter the question, and we'll do our best to get to those today. So Ed, why don't you maybe take a few minutes and kind of walk through what you're seeing in the economy and the markets?
Sure. Let me start with the most frequently asked question I get both from advisors and investors, which is, are we going into a depression? I actually asked that for first asking a question, which is, well, what's a depression? And I usually get the answer, it's really bad. And I agree it's really bad. I'm a mathematician by training. I'm a math geek, so I like using numbers. I'm going to use a bunch of numbers. Let's first talk about the depression. It started in August 1929, lasted 43 months. And the economy, GDP went down by 30%. Corporate profits earnings were down by 75%, peak to trough over 36 months. Unemployment peaked at just under 25%. And the stock market was down 86%, peak to trough over 34 months. More recently, we had what we call the Great Recession in 2008. By contrast, that lasted 18 months. GDP was down by 4.3%. Earnings were down by 40%. Unemployment peaked at 10%, and the market was down 50%, 50, peak to trough over 16 months. Last set of data, and then we're going to discuss. The average recession, last 12 months, GDP down by 2.2%, earnings down 15%, unemployment peaks just over 8%, and the market down 23%, peak to trough on average 9 months. Depression, unlikely. Why do I say that? Well, the depression happened because the economy was totally mismanaged when the downturn began. What do I mean by mismanaged? Well, you probably have heard these words a lot lately. Monetary policy, fiscal policy. What's it mean? Monetary policy is what the Federal Reserve does. They set interest rates. They provide liquidity to the markets. They make sure they're orderly. The Fed was kind of new back in 1929. It was just created in 1913. It wasn't independent. It was part of the Treasury, so it was political. And it really had very little experience dealing with crises, let alone making decisions in an unprecedented environment. They were more concerned with maintaining the gold standard, actually raising rates, than using lower interest rates to stimulate the economy. Fiscal policy. That's government spending, which also didn't happen much back during the Depression. President Hoover was not a real big advocate. He just was a cheerleader. He kept saying prosperity is just around the corner. It wasn't until Roosevelt came into office, the New Deal, FDR, that we had substantial government spending and ultimately came out of the Depression. The Great Recession, 2008. Monetary policy worked. The Fed was new at dealing with crisis. It took them a few weeks, but in time they got the financial system functioning, and we got fiscal stimulus out of the government. That took time. I don't know if you remember back then, but they couldn't get a vote to pass it. Should we bail out GM? Should we bail out Ford? Should we bail out the banks? And every time it went up for a vote, the market rallied, the vote went down, and the market sold off. But eventually we got fiscal stimulus also, government spending. This time around, the Fed was experienced. They knew what to do. In a matter of days, they got the financial system functioning. They lowered interest rates. They provided what we call liquidity to the system. Then the government actually acted quickly. It's shocking. The most divided government I've ever seen. And in a week, we got a $2 trillion spending package. So think about it this way. What do you need to live? You need three things. You need air, water, and food. First, you have to have air. You can't last long without air. And that's the monetary policy. That's the Federal Reserve lowering rates, getting the financial system functioning. But once you're breathing, you still need water. You can't go that long without water either. And that's fiscal policy. Okay, the financial system's working. What about the consumer? What about corporations? But ultimately, we don't live on just air and water. We need food, and that's corporate profits. And that's the big question today. When does the economy turn up? A V, a U, how rapidly? How low do earnings go, etc. I like using the IMF data, International Monetary Fund. They're not trying to be the highest or lowest. They're trying to get it right because they're trying to guide global policy. They're looking for US GDP down 5.9% this year, up 4.7% next year. Those numbers are important, not because the numbers themselves, but down 5.9%, up 4.7%. It means it's not till 2022 that we're back to the level of economic activity that we were back in 2019. So what you'd call a U-shaped recovery. And we would think that's a very reasonable scenario. The next question I'm getting increasingly, the economy feels awful. Why is the market doing so well? Which is an interesting question. It's not cheap. It was at the bottom, but right now it's actually selling at a relatively high price earnings multiple of earnings with earnings declining, and the market up 15, 20% off its low. So why did the market go up? Why did it get past fair value with the economic environment so problematic? And the answer I'd give you is what we call asset allocation. You see, the market is not just valued versus where it usually would sell. It's also valued versus where else can I invest. That's that asset allocation decision, stocks or bonds. And what happened late March, early April is an asset allocation decision. What do I mean? Well, stocks were down, bond yields had gone down, so the prices had gone up. Everyone was underweight stocks and overweight bonds versus where they were just 2 months ago. If you're an asset allocator, if you have a mutual fund, a pension fund, an endowment, or your advisor sets your asset allocation, let's say a normal 60% stock, 40% bonds, you had to, by mandate, go out and buy stocks and sell bonds. It was the asset allocation trade that's been supporting the market. That's why the low interest rates from the Fed help support the market. So that's why I think we've probably entered a trading range on the market. Upside really limited by the market not being cheap on declining earnings, but supported by where else am I going to go? Bonds yielding 0.6, 0.7% for 10-year maturity governments and 1.2 or so for 30-year. So I think more likely there's downside risk than upside potential. In a market, though, that's already had 11 days where it's been up or down 5% and 1 day where it moved 10%, where we're going to be plus or minus 15% on June 30th or on December 31st is almost folly to try to guess. Where would I invest? I think the best opportunity in the stock market is to focus on dividends. Dividends play a very important role. First, they're an important source of total return historically. Historically, dividend yield is about a half your return. If the market makes, say, 5 to 8%, you get 2 to 3.5% from dividend yield. That was a nice thing to have, sort of in your pocket every year. But don't go chase stocks that have the highest dividend yield. If it's too good to be true, it's often too good to be true. Make sure not that they paid a high dividend, but they can continue to pay the dividend. How do we do that? Well, we analyze the company, we stress test it. We look at the underlying cash flow, not under the most likely scenario, but under the most stressful scenarios. Can they pay dividends for a number of years under that scenario? And what our portfolio managers are asking our analysts to do is go a step further. Literally interrogate management and ask the company about their dividend. No, they're never going to say, yeah, we're going to cut it. That's inside information. They'll never tell us that. But they can say we have no intention of cutting it. We have the cash flow, as we would all know, and we intend to continue it as we've been doing for 10, 20, 50, whatever years. That doesn't mean they can't cut it tomorrow, but we want to know that they have no intention of doing it as well as the cash flow. So I think dividend strategies will be an important opportunity. And it's also a nice thing about quality. Companies who have and can continue to pay dividends tend to be high quality companies, and they will tend to lead the market in any sustained recovery. What about, lastly, investing in the bond market? Well, bond yields are low. They're too low. 0.6, 0.7% for a 10-year treasury, 1.2 for 30 years. You can't get there from here. What I mean, you can't reach your retirement goals, I don't think, or whatever goals you've set for your investments when the yield's about 1%. But that's the yield on a U.S. Treasury bond. That's a guaranteed payment. In theory, they can't default because they can always print the money. What I'm suggesting is you're going to have to buy bonds from other issuers, corporations, both investment grade and high yield, mortgage-backed, both consumer mortgages and commercial, international, both developed markets and emerging markets. And don't just buy one of them. Don't go out and buy a high yield ETF, for example. We think there'll be 9% default rates in high yield this year, up from 2% last year. Not only would you get your interest payment, you might lose your principal. So what I'm suggesting is, first of all, you have to be very selective. I'm also suggesting that you use all these different kind of bonds. Yes, some government bonds because they'll lower the volatility, corporate bonds, emerging market bonds, developed market bonds, because they tend to be risky at different times. When one zigs, the other zags. So let me just conclude. Depression, unlikely. We've seen substantial fiscal and monetary stimulus, record levels. Ultimately, economy rebounds in a U shape, maybe a rolling U. Gets better, then a little thread again, then a little better, then a little thread again. We think it could take about 10 quarters to go back to where we were before the coronavirus crisis began. Where would we be investing? Well, don't buy the market. One, it's not cheap, but two, why would you ever buy the market? It was never supposed to be invested in. It's an index. It's what's called a market cap weighted index. So you buy the most of whatever has already done the best because it has the largest market capitalization. I'll give you an interesting fact. At the market peak in February, S&P 500, 500 stocks, 4 stocks were 90% of the market's return. Netflix, Amazon, Microsoft, and Alphabet Google. So within the market, look to dividends as a strategy. And lastly, I think the best opportunity, stocks or bonds, actually is within the bond market, what we call credit risk, or buying bonds that are not government issued, those bonds issued by corporations and other governments and international and backed by mortgages, etc. In fact, on a risk reward basis, we pretty much know what the coupon's going to be, the interest payment, unlike the earnings, which is much more uncertain, and we're being well compensated for the risk of not buying a bond from a non-US government treasury versus where we have been historically. So that's it, Matt. I'm going to stop there. You got some questions? I'd love to have a discussion.
Thanks, Ed. That was really, really insightful comments. I appreciate you sharing those. It's good perspective. You kind of talked about and compared kind of this economic situation with the Depression. Taking that kind of a step further to the market, this is my third bear market that I'm going through. You've experienced more than I have. there's always kind of this behavioral recency bias that we as individuals have. And it's easy to look at this bear market and go, oh, it's similar to '08. And in some respects it is. The fiscal and the monetary stimulus elements are somewhat similar, but there's plenty of things that are different. Largely, this is being driven by a pandemic. I'd be curious your perspective as you kind of compare this environment with past bear markets you've seen. What are some of the comparisons you would make?
Every bear market I've seen was different than the last one. I began in '74, which was a bear market driven by OPEC and the oil cartel. Then '80 was a bear market driven by overvaluation primarily. The crash of 1987, Black Monday, actually was driven by excess valuations and basically a concept called portfolio insurance, which is we thought you could guarantee yourself by not lose money if you used certain option strategies. That didn't work out. We had the emerging market crisis in the mid '90s. We had the S&L crisis in early '90. My point is they're never the same. And that's why you analyze the market, use disciplines. The market will always be priced relative to earnings. The market will always be priced relative to interest rates, the two things I talked about. So I don't really try to understand the unknown. I try to understand the known, which is how markets are ultimately priced. And we come to a conclusion on whether the market, given all the uncertainties that make every new bear market different, where is the market today versus where it should sell? Make sense?
Makes sense. Makes sense. I appreciate that. You commented on the bond market, in particular the opportunities in corporate bonds, and you're now actually getting paid a little bit to take some of that risk, especially when if you can do your research and know what that coupon and that interest payment is going to be. As we look at the bond market, the Treasury's kind of come out and said they're going to have to issue $2.9 trillion worth of bonds likely here in the second quarter, varying different maturities. But the Fed's involved, and the Fed can and probably will purchase some of those bonds themselves. How do you we've never been through a period where we've issued $2.9 trillion worth of bonds in such a short period of time. How do you wrap your head around that, and what potential implications that could have on the bond market?
Well, you gave the key answer there, Matt. The Fed's going to buy the bonds the Treasury issues. The Fed is going to fund the government spending. I mean, that's the deal. Ultimately, we're going to have to pay back the debt. That's the long-term concern. How do we do that? Well, it's really, by definition, obvious. We hope there's a point in the future where the economy is growing again. And when the economy is growing, we will pay higher taxes and government will cut spending. And that's how historically and traditionally you recoup the spending you need to do to stimulate an economy during an economic crisis like today.
That makes sense. Let's talk about diversification for a little bit. In your comments, you did talk about just the role that rebalancing portfolios have played kind of in the market rebound and that asset allocation has. It's a topic we discussed quite a bit as a firm, is diversification and how to think about it, particularly as we go forward. We know over the last 20 years or so, the global stock markets have become more correlated. International stocks and U.S. stocks tend to track each other more tightly than maybe they did prior to the late 1990s. Bond markets are different today because you're hardly getting any yield, and alternative investments have just become a more widely respected asset class, and more people have added alternatives as a component to their portfolio. But given what we've gone through, in your mind, does anything change in how you think about or should think about asset allocation going forward relative to maybe how you thought about it prior to this pandemic?
Well, no, actually my view on diversification is you always want to be diversified as long as there's attractive valuations and fundamentals. I've been uncomfortable with investing in European and Japanese equities for a very simple reason. Japan is disappearing, literally. Japan at its peak in 1994 was 18% of the world economy. Now it's 6%, and it's going to go down to nil. its GDP growth is 0 or negative. Its population is shrinking. So, why agonize over should I be in Japan when it's becoming a rounding error in terms of its impact on the economy and ultimately its share of the global market? And Europe, as we've seen, is really troubled. But it was before coronavirus. That's what Brexit was about. You can't have a monetary union with a common currency and a common interest rate without a common government to control fiscal policy. I mean, the US works because people in California and Michigan and New York and Massachusetts are paying taxes to support, no disrespect, Mississippi and West Virginia. But, will people in Germany support and build bridges in Greece and Italy? In fact, the biggest funder of Italy over the last year, even before coronavirus, actually has been China, supporting, expanding their ports, etc. So Europe, I think, is troubled by a concept of economic union that didn't work. And by the way, Europe also the European stock market is dominated by banks. They're about a quarter or more, the financials are about a quarter or more of the index. And unlike the US, where we fixed our banking system in 2008, Europe never did because they never had a common government to force some banks to close. And the French weren't going to fix their banks until the Spanish fixed theirs, and the Spanish would fix theirs, so the Italians fixed theirs. So every country has at least 2 banks in Europe. That'd be like every state. There was a time when I started where there was a First National Bank almost of every state, from Texas to Oklahoma to Kansas. Well, we have about a dozen large banks today that are very solvent. Europe has dozens of national banks that are very troubled and challenged by negative interest rates, which make it almost problematic to be profitable. So, yeah, I believe in diversification, but some areas, that doesn't mean there aren't opportunities within Europe or even within Japan, but you have to be very selective on the companies you're buying.
Okay, no, I appreciate that. Just to on your earlier comments of the opportunity in dividends, and I can appreciate what you said there, that there's nothing better than getting part of your return in a dividend, especially when it's kind of a continual stream of cash flow. But just to play devil's advocate to that, right? The news today is Disney's decision, right, to suspend their July dividend payment, and that kind of came out of the blue. I don't think as many people expected that. Is it harder to be a dividend investor these days because of the lack of certainty in companies probably making pretty quick decisions to choose to change their dividend payout ratio?
Yeah, it is absolutely harder. And therefore, you can't buy a passive dividend index or an ETF or something. You need, I'm not giving a commercial for what we do, but you need someone to actively go over, review, and make sure they can do it. I mean, I can't know specific companies, but the idea that a company that's dependent upon sports viewership or leisure entertainment might not have confidence in future cash flows, I would hope our analysts would understand that.
That makes sense. I think this is, in our view, we think this is a great opportunity for active management and rigorous analytical research like you guys provide at Columbia Threadneedle. So I agree with that. Kind of a question that came in from one of our listeners was kind of on, you talked about the IMF's projections that it would be up until 2022 till we really get back to where our economic productivity was coming out of 2019. I think tying with that is just consumer behavior. We have, unemployment rate that's probably going to be mid to high teens, at least in the near term. Could it take longer for that consumer spending to come back because those consumers have been laid off and it's going to take some time for them to find a job and ultimately rebuild their financial situation?
Yes, the IMF was cautious on their 2021 recovery, saying, it requires, excellent execution by governments and central banks. They have more confidence, obviously, in the near-term down than the upturn in 2021. But, talking with my colleagues in our economics and our quantitative group, we're feeling 10 quarters from now, which is 2.5 years, we're back at levels of economic activity we were before the crisis.
Okay, so it'll take some time, but we may get we'll get there eventually. What about inflation? So, question that's on people's minds, kind of in the back of their mind. I'll admit it's even just in the back of my mind. Uh, it's hard to wrap your mind around 2.9 trillion of treasuries just being issued this month or this quarter. But at the same time, I'm not really too worried about inflation in the near term. Do you think a year or two from now that's going to be a hot topic and something we're all actively worried about and the Fed's trying to fight?
Well, here's a key point the Fed's trying to fight. What I think everyone I know in the business, every economist I know, certainly every Fed governor would welcome inflation. They've been trying to get 2% inflation for a few years now. They haven't been able to get us up to that level. But I don't think anyone should be worried that inflation gets too high, because inflation is a discretionary event. What do I mean? The Fed can always stop inflation. All you have to do is raise rates. The problem is you can't always start an economy by cutting rates because you can't really go below zero. We learned it doesn't work in Europe. But let's assume inflation gets to 4%. Well, that means the economy is growing, so the Fed will slow the economy and raise rates to 6%. There were markets where inflation got to 10%. I don't know if you guys were around back then, but Paul Volcker in 1980 raised rates to 22%. And he gave us the worst recession since the Depression through that date. If you're willing to have an economic downturn, and that's why you are, because inflation is roaring because the economy is growing, then inflation goes away. So you'd have to think that the Fed will fail to do their job and fail to raise rates despite a roaring economy that's leading to rising rates. That'd be malfeasance, incompetence. And it certainly doesn't sound like this Fed or the European Central Bank, for that matter, or the Bank of England is inclined to let inflation run out of control.
Yeah, no, that makes sense. Shifting, I know I'm kind of going all over the place, but another question we had coming in, back on kind of the bond market. So your comment of there clearly is more opportunities in investment grade bonds than there was prior to or coming into the year. And we would agree with that. But you kind of look at what's happened in the bond market, similar to the equity market. You've really seen bond yields come back down quite a bit since the lows of late March. Is there still enough of attractive opportunity in the lower end of investment grade or even in the high yield space right now at yields, especially given the lack of, clarity on how companies are going to perform coming out of this?
Yes. I'll give you, for example, if you look at investment grade, yeah, yields have come down, but they're still over 2 percentage points over what we call benchmark. Okay. At the end of March, they were about 300 basis points. So they've come down. But they're in the 85th percentile. In March, they were in the 99th percentile. In other words, you've gotten a better deal than this only 15% of the time. At the end of March, you got a better deal than this only 1% of the time. High yield is in the 86th percentile. It also was in the 99th percentile. So at the beginning of this year, all these risky bonds were like in the first or second percentile. You were getting, like, in high yield, you're getting about 200 basis points over benchmark. Now you're getting over 750 basis points over benchmark. Well, everyone was taking a lot of risk for a little more return. So yeah, we are still seeing way above average in most risk classes in the bond market today. Obviously not as high as we were during the liquidity panic last week of March, early April, but still statistically in the 85th percentile. That's better than passing.
Yeah, that is. Yep. I know I'm going all over the place on you, Ed, but you're great with these responses. Appreciate it. Back on kind of the Treasury's issuance of debt and the Fed being an active buyer of that. Is your expectation that the Fed will be the dominant buyer or will be buying all of that 2.9 trillion? Do you have any sense of how significant it will be the Fed versus essentially other investors buying it and that being kind of true money printing?
The Fed and maybe some other foreign central banks primarily.
Okay. Got it. I'd be curious. I haven't seen this data. I'm not sure if you had. It's probably too early to say yet, but it obviously is a challenge if you're looking at retirement right now and going through what's going on in the market to make that decision of whether you want to go through it or not. And I think our advice is, even though you do retire, that's not the end of your investment profile. You still need to continue to invest through retirement. And so you still have to keep that long-term hat on. But have you seen any data as to whether or not there's been kind of a slowdown in the number of retirees kind of over the last couple months? I haven't. I figured there was a question that came in.
I haven't seen that data at all, no.
Okay, got it.
It'd probably be hard, Matt, retiring. Well, if right now you can get, PPP plus unemployment, you wouldn't retire until that's done anyway.
Yeah, true.
Well, you would, but it'd be dumb.
Got it. What about, I've got a couple of questions because kind of back on kind of the topic of diversification. And so, diversification to equities, we talked about bonds and there being an opportunity in bonds. So I would throw out there that bonds is historically been a good diversifier to equities, and with more opportunities there, that is an opportunity. But also on the income side of things, bonds, if you need income, bonds aren't giving you a whole lot today just because of where the absolute level of interest rates are. So kind of a two-pronged question of, in your mind, are there other good alternatives or diversifiers to both stocks and bonds that we haven't talked about? And on top of that, within that, is there certain diversifying assets that might also provide a nice income stream for income-oriented investors?
Well, high yield bonds are giving you 8 to 9% right now. Then again, we think there's going to be a 9% default rate in high yield, up from 2% last year. So again, you need to be selective. Are there other asset classes? I wouldn't be in commodities. Yes, if and when inflation ever returns, maybe. But I don't see any math that has a shortage economy for, let's say, several years, 3 to 5 years. So commodities are a traditional low correlated diversifying asset, maybe a normal exposure or below normal, but certainly you're in there for the diversification characteristics, not for return. Obviously, there are alternative strategies. There are many different kind of alternative strategies, so you'd have to be very selective within them to see what's the driving force. Some have low correlation to stock and to bond. So yes, they serve the diversification force factor, but what is the return? Is it a leverage alt? And therefore, is leverage actually going to hurt them given their strategies? So I'm going to keep throwing this word. I've known this 45 years, just you've always had to be selective, but in the more difficult markets, you have to be very selective. What's the old saying? When the tide goes out, you see who's wearing what.
Yep. I agree with that. Another question came in. It's a good question and a topical one. Obviously, a lot of news this week in kind of U.S.-China relations, and Secretary Pompeo's comments may have not have helped that situation a lot. How do you think China's going to affect the economy going forward? The U.S. economy?
China's probably in a recovery. China will pass the U.S. as the world's largest economy in someplace between half a dozen and 10 years. China is trading aggressively with much of the world, particularly the emerging world. So the question is, should we trade with China? I can make a good case that for strategic things, we should not. I would not depend upon China to make our military airplanes or our submarines. Obviously, right? Although I think a shooting war is a 20th century concept, and more likely we'll have cyber wars than we'll have shooting wars, but we'll still have a standing army. Should we depend on China for medicinals? Well, it depends what kind of medicinals. Are they pretty generic and widely available. I don't think we should become xenophobes and close off and become independent producers of everything. Do you really want to spend $250 for a T-shirt at Walmart because it was made in America? I remember back in, it was the late 80s. I was giving a speech in Pittsburgh. And I said, if you want to make, and someone said, Ed, we want to make steel here in Pittsburgh. Why don't we? And I said, look, if you want to make steel in Pittsburgh, you got to be prepared to live like a Korean steel worker. That went over very well there. A couple of years ago, I was speaking to Korean investors, and I said, if you want to make steel in Korea, you have to be prepared to live like a Vietnamese steel worker. So, there's a global price to everything, and many things we should not make here because either the price becomes absurd or you're paying people a wage rate that no one will accept, so we can't make it. So China is growing rapidly. Emerging markets are growing rapidly, and they're going to continue to because, look, they haven't done it yet. Output per worker in the United States is $108,000 per year. In the average emerging market, it's about 9,000. In China, it's 13,000. At the low end, India, it's 3,500. So to make American workers more productive, we all use Zoom and .echo and 3D classes and artificial intelligence. You know how you make someone more productive in India? Pave a road. Literally, it takes 3 weeks now to get goods from Mumbai to Delhi. The roads stink. They're actually putting in a high-speed rail. It'll be 13 hours. In Indonesia, put a light bulb so you work late in the day as it gets dark. So the reason those economies are growing so rapidly is they're just not productive like we are. I mean, I want to live here. This is the greatest country in the world. I want to live at this standard of living. But the rapid growth is going to come in those emerging markets. Now, as investments today, very volatile. And also the least developed health infrastructure, so more near-term risk from coronavirus. But for the long term, they're going to dominate the world economy. The world will trade with them. We will probably have to make a decision what we will and what we won't trade with them.
Yeah, I appreciate that. That kind of hits the questions we've received, and a lot of those questions kind of hit what I had. If I could kind of just recap what I've heard you say, Ed, is this isn't a depression. It isn't a depression because the federal government and the Federal Reserve both acted quickly and swiftly in a significant magnitude. No bear market is alike, so while there are some similarities with this and past bear markets, there are clearly going to be differences. And I think a key point you made throughout your comments today is you need to be selective, whether that's in owning dividend yield stocks or corporate bonds or the like. I think this is a period of time and a period of the market cycle where, investing in with active management and investors who are focused on doing their fundamental research will really add value. So I think some great points and great perspective, Ed, and having somebody that's had your experience and seen the market from so many different angles is invaluable. And so thank you for your time, and I want to thank all those who've tuned in and carved out part of their afternoon for taking time with Telemus. Thank you all, and have a great afternoon. Stay safe.